Interestingly enough, as China has begun to move away from its zero COVID policies, you can see down in that orange line, Chinese prices, which I would say kind of represents the global floor of where steel prices ultimately are, has moved a fair amount higher by about 10% in the last couple of weeks. Taking note of that, we've also had US prices moving higher by, I'd say $50 to $75. European prices have moved higher by about the same. All of them are staying relatively converged in terms of their relative price structure. It looks a whole lot more like pre-COVID type phenomenons where the US just tends to trade at a little bit of a premium to these other regions, but the spreads are tight and all of them in concert are going a little bit higher right now. For now, I don't expect this to take off and go back to $2,000, but certainly it does appear as though for now, the trough is in, we are bottoming. It looks like we're seeing a little bit of upside in the coming months. And the futures market corroborates that. Both the futures market on the hot roll side, which is shown in the white, as well as the implied cost of making steel using busheling scrap futures, which is shown in yellow. Basically what that's doing is it's taking the busheling scrap futures market, it's adding on $300 to kind of give an implied fair value of where steel prices should be. They're pretty much in lockstep with one another in terms of where the fair value sits versus where the current steel futures market is. That being said, it is worth noting that some of these prices, as we look out into May, June, July, those are in excess of $800 a ton, which is more than $100 above where we currently sit. So that's the market's way of saying the expectation is that CRU and steel prices generally are going to continue higher as we roll through the months ahead. And the early look for January scrap prices, as we sit here today, for the key indices is up $30 per ton for most of the scrap grades. So it looks like a similar phenomenon is happening on the raw material side as well. Now with China reopening, although I do think it's going to come in kind of fits and starts and they're going to have their own headaches to deal with, the commodities and the raw ingredients that are linked to China and linked to steel are taking notice. And you can see that here, we've got the white line, which is going to be Chinese iron ore. It's moved higher by about, let's call it 25–30% since beginning of November. And then you've got Australian coking coal, which maybe is a little more muted here. It's obviously come off extremely high levels, but coking coal markets have started to respond as well, and that's shown on the left axis in the blue line. One other notable thing that's happened is with China reopening and with China kind of, redetermining who they want to be friends with and allies with and buy from, they did announce that they are contemplating lifting a ban that they had put in place on Australian coal. So ultimately that makes Australian coal more attractive. You can see that in the price action over the last couple of days, fairly notable. My guess would be that probably continues as China gets back to a more normalized demand schedule. Now, on the production side for U.S. mills, this trend it continues to get worse. I don't know, for lack of a better word, as prices have gone down and down and down on steel, steel mills have reacted domestically by reining in production capacity utilization, which for those who are new, that is taking the production that's totally available for the United States and then looking at what assets are actually producing, what tonnages are actually getting produced, and then creating a percentage on that. And you can see that for the last couple months, maybe the last 5 or 6 months, capacity utilization has moved pretty rapidly lower. We're now sitting at 71.8%, which is really the lowest we've seen since back when steel prices were down around $400 or $500 back in 2020. So this is certainly the steel mill's effort of trying to balance supply demand conditions, ensure that prices stabilize, maybe see a little bit of upside. And worth noting, I don't have a chart for it, but I saw a headline earlier this week that Turkish production utilization is down at 50%, which you can see here in this chart. U.S. production utilization never even got down to 50% during the COVID times. Those are pretty staggeringly low production numbers. So, there are definitely some regions of the world that are trying to fix the supply side of the equation to make sure that prices bottom out and maybe trough and turn a little bit higher. And then I think this is the last slide. On the plate side of things, we're beginning to see, we're continuing to see the convergence of what we've been talking about for the last couple of months, which is steel plate prices are coming fairly rapidly lower, while hot roll prices, sheet prices are beginning to turn a little bit higher. Those two things in combination are basically closing that gap or that spread between those two products. My gut still says this trend continues. And one of the main reasons for that is because earlier this week, Brandenburg, which is a steel mill that's been commissioned and is beginning to produce, has actually started to produce its first plates of steel here this week. So that's just going to add more supply to the equation, better balanced supply demand conditions, and arguably bring spreads between sheet and plate back more into line. So with that, that is all we've got for this little rendition. I've got one last little teaser on the back end post Q&A, but we'll go ahead and